Hi there, welcome back. In this video, I want to walk you through the most important TanukiTrade swing trading metrics, all visualized in the TradingView chart. These are the tools and indicators that we have developed in-house specifically for traders who are using options for swing trading ideas. My name is Gery and I am the Chief Options Expert at TanukiTrade. In this video, it's not about indicators in the traditional sense. It's about how options markets price risk, and how you can see that information visually on TradingView without, jumping between broker platforms, option chains, and specific custom spreadsheets. Everything you will see here is designed to answer questions like that. Are options cheap or expensive? How are they priced right now? How much movement is already priced in? Where does probability really sit? And which side of the market is paying more for the premium? Before we go any further, one very important clarification. This video will not be about GACs. Gamma exposure is a deep and complex topic, and it deserves a separate dedicated video that I will create later on in the future. So in this walkthrough, we are not going to discuss dealer gamma, how hedging works, and different several GACs concepts. That's coming separately in another video. In this video, we will focus exclusively on two core TanukiTrade indicators, the Options Overlay Pro and the Options Oscillator. The GACS Pro, I can already hide it, just not to be confused by that, so I can hide this indicator, and we will talk about that in a later video. So what I will cover in this video is the Options Overlay Pro and the Options Oscillator, its settings, its best practice, and stuff like that. In a nutshell, the Options Overlay Pro indicator brings real options market data directly onto your TradingView chart. This includes like implied volatility context, expected move, standard deviation, database probability levels, vertical and horizontal skew that we will talk about later, expiration structure, and a dedicated options grid system. The Options Oscillator Pro on the bottom of your screen plays a different role. Instead of plotting information on price, it summarizes the options volatility environment and pricing skew that we will cover later on. Here we will focus on IV rank, the absolute implied volatility, the volatility momentum, and call versus put pricing. So these two indicators together form a complete swing trading framework for options traders. And there is another note that you have to be aware that we are covering more than 150 liquid US market symbols, and we are continuously expanding the symbol list with only major and liquid underlyings in the US stock market. Liquidity is very important in options trading, otherwise you will trade with very wide spreads. The implied volatility can be skewed, so we are focusing specifically only for high options liquid underlyings in the US equity market. So all in all, this video will be for swing traders who are using options instead of stocks, traders who are selling premium but care about the structure, traders who buy options but want to avoid overpaying, and anyone who wants to understand options pricing and not just price action. You don't need to be an advanced quant to understand this video, but you do need to care about how options market price risk. So one recommendation before you start, this is not like a skip through video. I strongly recommend watching it from start to finish in order, because each concept builds on the previous one. So hopefully by the end of this video, you won't just know what these indicators do. My goal is that you will understand how to think with them and how to use them in your own trading everyday practice. All right, with that context in place, let's start with the first tool, the Options Overlay Pro, and how it brings real options data directly into your TradingView chart. Let's get started with that. So in this part of the video, I will introduce you something that has never really existed on TradingView before we invented it at TanukiTrade. The real options data visualized directly onto your chart in a way that actually makes sense for options traders. It has never been existed in TradingView before. We love TradingView. TradingView is just an excellent platform. It's fast, flexible, and visually clean. But historically, it has had one major limitation. It never showed the real options market information. So if you trade options seriously, you already know this problem. On TradingView, you can see the price, you can see the trend, the support, the resistance, the momentum indicators, but you never see how expensive options are, how much movement is already priced in, like an expected move, where the delta exposure really sits, or where the market is paying more for calls or puts. You never see this in TradingView, except when you are using the TanukiTrade indicators. Usually for that to see, traders generally need to switch between platforms, TanukiTrade, Thinkorswim, interactive brokers or other broker tools, or different analytical tools separately. We wanted to build it right into the TradingView chart to see everything in one simple layout and help options traders to use them in their everyday practice. Before we dive into the nitty-gritty of the indicator, this indicator was designed, developed, and maintained by options traders. We at TanukiTrade have been trading with options more than 20 years now. So this is designed and developed and maintained by options traders. It's not designed and maintained by developers, because the design philosophy here is not how many features we can, put in the software. It's the main goal is, what does an options trader actually need to see at decision time? How can we help options traders to see the real options metrics in TradingView? That was the main goal of this indicator and the indicator set. In addition to the options metrics that you will see, this indicator, the options overlay, also includes a unique grid system designed specifically for options traders. This grid system has two dimensions. On the horizontal axis, you will get to see the Merrimack levels. This is an enhanced Merrimack system, not as arbitrary lines, but a structured price framework. And on the vertical axis, you will get options expirations. So this allows you to assess how price interacts with key levels across different options expirations at the same time. This is something you simply cannot do on standard options platforms. Before we start to understand what indicator shows you, we have to clarify what this indicator is not. This indicator is not telling you the future. It does not tell you where to buy, where to sell, or where the market will go. No indicator can tell you that. This indicator helps you understand the options dynamics, the options metrics, and the pricing around it, and how you can capitalize on it if you know how to trade with options. This is specifically for options traders. If you don't know anything about options trading, this video will not be helpful for you. So this is designed for options traders. So after we are done laying the groundwork, let's talk about one of the most important aspects of the Options Overlay Pro indicator, which is the delta curve, the interpolated delta curves. If you are a serious options trader, you know that delta is not just a number. Delta is probability and directional exposure. What we are doing here is taking the abstract concept and making it visually actionable for options traders. Inside the indicator settings, if you click here, you can see that the curve settings and layers here, and curve is enabled by default. If you want to change the curve delta, which is by default 16, you have to change the number in here. So for example, if I change it to 25, the curve will change. See how it narrowed down, because 25 delta is is closer to the current market price. If you change back to 16, that's the standard default settings of the indicator. So each and every delta curve represents a theoretical option strike distance based on probability, not arbitrary price levels. So if you want to see the expected move based on delta, this is where you set the settings in here. You can go by 30, you can go by 40, depends on your trading strategy. Usually we are using the 16 delta curve. You know, most traders who are trading with options are not only thinking about strikes, they are thinking about delta, because strike price is just a number, but delta tells you how likely that strike is to be touched and how sensitive that option is to a price movement in the underlying. So for example, if you are looking at the 16 delta option, roughly that implies about 84% probability being expired out of the money at expiration. A 30 delta implies a much higher chance of being tested. So for example, if we are looking at these levels, these are 16 delta levels at this time. So for example, on the 9th of February, there is a 16 delta probability of hitting this price level, which means that there is an 84% probability that if I sell this option, for example, it will expire out of the money and I get to keep the premium. So actually, when you are choosing a delta, You are also choosing the risk, the probability, and the payoff profile, not just the distance. Data is very important for options traders. And for example, if you are an iron condor trader, you need to understand how the data curve looks like. And that's how you position your iron condor, around the probabilities and around the data based on the current options pricing. By plotting this data curve on the chart, you can instantly see where the probabilities lies, where the risk expands, and how the premium is priced. Because if we are looking at an underlying where there is a huge call options pricing skew on the upside, you will see this data curve skewed. I will show you examples of that later on. And there is one more technical thing I wanted to share with you, and this is very important and pretty unique to Options Overlay Pro. We are not plotting rounded strike-based data. Instead, we are calculating interpolated data from the actual option chain of the underlying asset. Let me explain why this matters. On most brokerage platforms, data values are shown per strike, and they are usually rounded. So for example, you might see a strike labeled 0.16 data, but in reality, that 0.16 data can be 0.1625, 0.1578, or something like that. That rounding error matters a lot in options trading. What we are using in this indicator is that we are taking the real options chain data and apply the Black-Scholes model to it and interpolate the exact price level where a true 16 data should exist. So we are not rounding, we are interpolating from the options chain. This means that the 16 data curve you see on the chart is not the nearest strike. It's exactly the 16 data distance that is mathematically accurate and interpolated from the option chain. This obviously applies to 20 data, 25, 30, and the rest. Because we are not rounding, we are not estimating, we are interpolating from the real and live options chain. So if you are an options trader, you know that data is very important for you. And data is not a trade signal, it's the structure. It shows you where the probabilities are, where the risk accelerates, and how sensitive the options are for the underlying change. That's why it's important to see the data curves on TradingView. And that is why you can also adjust the settings based on your preferences, but the default is, again, 16 data. And if you want to get rid of the OTM data, just click in here and it will be gone. But normally it's set by default. And it's also important to understand that data curves updates automatically. So it's a dynamic data curve based on price changes and volatility changes. You don't need to adjust anything during the trading day. This adjusts automatically, dynamically from the options chain. Now let's talk about the other curve that we also implemented in Options Overlay Pro, and that's the binary expected move curve. If data curves are your probability map, then we could call the expected move is your range of realism or something like that. This is a metric that answers one of the most important questions in options trading. How far does the options market actually expect price to move by expiration? Not how far it could move, not how far you feel it might move, but how far traders are actively paying premium for. That's a different curve than the data curve. Expected move represents a predicted dollar change in the underlying price by a specific options expiration with roughly 68% statistical certainty or probability. The 68% number is not a random number. It comes from the standard deviation logic, meaning that statistically price is expected to stay inside the range about 2/3 of the time. So when you see an expected move range on the chart, you are looking at the market consensus expectation. This is not random opinion or technical level. This is a risk being priced into the options chain. So if you click on the curve binary expected move, it will show you a different curve than the previously set. And as you can tell, the binary expected move curve is symmetrical. The other one is not. The other one, if you look at the data curve, the blue line, it's skewed to the downside because SPX is always represented by a pricing skew on the put side, so that's why it's skewed. But the expected move is always symmetrical. No matter what product, which underlying, which stocks or ETFs you are looking at, the expected move, the binary expected move, is a symmetrical curve. For another example, let's switch to Tesla and see how the expected move differs from the data curve. Right now, what you can see that the delta curve is skewed to the upside, and you can also see that with the pricing skew down here. We will talk about that later on. But this is skewed to the upside, which means that call options are more expensive than put options. But the expected range is also symmetrical, as you already seen on SPX. So this is a symmetrical curve, always the expected move, and the delta curve is always based on options pricing and the delta distance. So that's a different curve. And there are multiple ways to calculate the expected move, but we are deliberately choosing the TanukiTrade method because in our experience it's the most expressive and most robust. And why are we doing that? Because the TanukiTrade method is not only relying on one single option price, they are blending information from the at-the-money straddle, the first OTM strangle, and the second OTM strangle, and this creates a more realistic picture of how volatility is distributed across strikes. This is the exact calculation we are using, the at-the-money straddle price multiplied by 0.6, plus first out-of-the-money strangle price multiplied by 0.3, plus the second out-of-the-money strangle price multiplied by 0.1. That's the exact calculation behind the expected move curve. Let's make a comparison between the TanukiTrade and our TradingView indicator settings or values. I marked down the 20th of February as the expiration vertical line in here, and also changed the February 20 in Tesla in the TanukiTrade trading platform. And if you look at the ruler, this brown line shows you the expected move. So right now the brown line, the bottom of the brown line is around 390, which is exactly our level in here, the 390. And the upside or the upper part of the expected move is around 475, and this is exactly here 475. So we are matching the TanukiTrade expected move levels on our TradingView indicator. So if you are used to watching these expected move levels on TanukiTrade, you can find it on TradingView indicator as well now. Now let's see the third curve that we implemented in our overlay indicator, which is called the standard deviation 1. So that's the standard deviation expected move. It's a different expected move than the binary expected move. I will explain why it's different. So if the binary expected move shows you how the options market is pricing movement, then the one standard deviation, this line, shows you how volatility theory describes the probability distribution of the price. So it's also another different curve. These two concepts are closely related, but they are not the same. And understanding the difference is, one of the biggest steps toward thinking like a professional options trader. So let's talk about the one standard deviation line that you see in here. These gray lines are the one standard deviation lines and how they are calculated. In probability theory and options literature, what you find is that one standard deviation represents approximately 68.2% of the outcomes in a normal distribution. So based on the current implied volatility, there is roughly a 68% probability that the price will finish inside the one standard deviation range by expiration. This is a foundational concept in options pricing, and it's important to understand. It's not a direction. It's not a prediction. It's not telling you the future. It's telling you the probability distribution of price based on the 68.2%, and that's it. So you might ask, okay, guys, how do you calculate the standard deviation then? Right now, the standard deviation equals the closing price multiplied by implied volatility. So going back to the expected move is derived from actual options pricing, specifically at the money and out of the money options that traders are actively buying and selling. On the other hand, the one standard deviation curve is derived from the averaged implied volatility, specifically the aggregated IVX for that specific expiration. So one is a market priced curve, the other is volatility priced curve. They are different, but they are both valid for options trading and for probability measurements. You might also ask then, why do you guys show both curves? Do you want to confuse us? No, absolutely not. We are showing it intentionally because they are showing you different metrics. The expected move shows you how much movement traders are paying for, And the first standard deviation shows how volatility theory distributes probability over time. They are different. When both curves are enabled, as you can see on the chart right now, the indicator fills the area between them with a light gray shade. This is not just a visual choice. It reflects the idea that both metrics represent probability distributions, and the shaded area is usually where reality lies. So here is a key insight for you if you want to use the curves. Instead of obsessing over whether the expected move or the one standard deviation is correct or which is correct, which one is not correct, it's far more useful to treat the area between them, the gray shaded area between them, as the most realistic expression of the 68% probability zone. So don't just look at one standard deviation or expected move, look at the gray shaded area. That's the more probable zone for the 68% probability. So if you want to measure the probability of price distribution, don't just watch for one metric. Use both and look at the gray shaded area. That's the highest probability you can get around the 68% zone. After we have covered the probability, expected move, and delta curves, now move on to the IVR dashboard panel on the bottom right of the screen. If you click on the settings above here, you can set the position wherever you want. Right now it's bottom right, but you can set it to the top right. It depends on your personal settings. And these are the default settings. I enabled weekly IV skew. I will talk about that later, what a skew is. But the IVR panel is like a volatility control center. While, the delta curves, expected move, and standard deviations shows you where the risk is on the chart, the IVR panel, this panel, shows you what volatility regime you are trading in. And what I see as one of the biggest mistakes of options traders is that they are looking purely at implied volatility in isolation. They see a high IV number and think, okay, volatility is high or volatility is low. But without context, those statements are, just meaningless. So the IVR dashboard panel is designed to give you relative volatility context, absolute volatility context, and the recent volatility momentum. That's why we call it an IVR dashboard panel, which tells you which volatility regime you are trading in. So now let's talk about the IV rank, which you will see here. The IV rank is answering one specific question. Where is the current implied volatility relative to its own history? So it's a rank. It's not an absolute number. It's a relative number. It compares today's implied volatility to the highest and lowest implied volatility levels over the past 52 weeks. So if there is a range, it compares the highest to the lowest part of the implied volatility, and that's why it's showing you a range, a rank. We are using exactly the same methodology used by TanukiTrade, so if you are familiar with their platform, this will feel immediately intuitive for you in practice. Now let's change to Amazon just to show you that we are color coding the IV rank. Right now you see an IV rank of 41 at Amazon, and this 41 is a little bit above than Tesla. So that's why we are color coding it. Between 35 and 50, we show it in orange. Between 50 and 70, it will be shown in red. And above 75, we are showing it in deep red. So we are color coding the IV rank just to make it easier to understand what type of volatility regime you are trading in. So IV rank answers you one very specific question. Are options cheap or expensive? That's it. It answers you the question, based on the last 52 weeks, are options overpriced or underpriced? Now let's talk about the IVX in this panel. IVX is the implied volatility index, calculated in a similar way to how the VIX is calculated for SPX. Just like the CBOE uses SPX options to measure market volatility, IVX uses options pricing to estimate expected volatility for each underlying. But instead of a single market index like VIX, IVX is calculated per symbol and per expiration cycle. This allows you to analyze front month versus back month volatility, term structure, shape, and volatility skew across time. What we are showing you in the panel as IVX is the average implied volatility value up to the optimal expiration, which is around 45 to 60 days. Right now we are showing the 58 days to expiration IVX, which is 41.8. But never look at this number in isolation. Always look at the number with the IV rank, because IV rank tells you the relative value of this IVX. Because there are stocks that have high IV all the time, but still have a lower IV rank. And also the opposite is also true. So always watch the IV rank and the IVX together, not separately, because IV rank is a relative number, IVX is an absolute number. Now let's look at the IVX 5-day change, which is showing you how the implied volatility moved in the last 5 trading days. Obviously, if it's green, then implied volatility is rising. If it's red, its implied volatility has been decreasing. And right now we are looking at the Amazon chart, and you can see that there is an expiration coming up. So it's obvious that implied volatility has been rising. Right now what we are looking at the implied volatility on the oscillator, but we will cover that later on. So IVX 5-day change will always tell you how much implied volatility has changed in the last 5 trading days. So in and of itself, these 3 metrics are very important, because IV rank tells you where volatility is, IVX tells you how high it is right now, and the IVX 5-day change tells you where volatility is going. So these 3 numbers are very important for options traders. The rest that you see on the IBR panel is the call pricing skew. We will cover that later on using the histogram down here. The implied move, that is expected move for the first expiration, and also the weekly skew. And here with this number, you see that when was the last time the indicator refreshed. And since I'm recording this out of trading times or market open times, this was 12 hours before. So for example, if we are going back to Tesla, I wanted to show you something, that this implied move, this number is around the same number that you see here on the platform on TanukiTrade. The first expiration implied move 9.52 is around our level 9.8. It has not been refreshed since 12 hours, so it will change when the market opens. But this is expected around the same number as you see on the TanukiTrade live platform. So the implied move or the expected move is always showing you the first expiration implied move based on options pricing. Moving on, let's talk about another important aspect that we are showing on the chart. This is called the vertical pricing skew. To understand what vertical pricing skew is, let's talk about that. If implied volatility tells you how expensive options are, and expected move tells you how far the market expects price to travel, then the vertical skew tells you which direction the market is paying for. This is where the market sentiment starts to become visible through pricing. At TanukiTrade, what we are showing or calculating as vertical pricing skew always refers to the difference between the pricing of put and call options that share the same expiration and are located at the same distance from the current at-the-money market price, specifically at the expected move level. This is extremely important. We are not comparing random strikes. We are not comparing at-the-money options. What we are comparing are puts and calls that represent the same probability distance from the price, from the current market price. This makes the comparison clean, objective, and meaningful. So why do we measure the skew at the expected move? The expected move represents the market consensus range where price is statistically likely to end up. By evaluating this distance, we eliminate the noise caused by the random strike selection, and we are focusing purely on pricing asymmetry. And the obvious question might arise, what if I don't find strikes at the expected move level? This is where we again use the interpolated calculation that I also shared with you by the delta curve definition. The interpolation takes into account the neighboring option prices, their distances from expected move, and using the linear interpolation, we determine the theoretical price of both the call and the put exactly at the expected move distance. And once we have those two prices, the interpretation is pretty straightforward from them. If put options are more expensive than call options at the same expected move distance, the market is paying more for the downside protection. And vice versa, if call options are more expensive than put options, the market is paying more for upside exposure. What we can see in this example is that the market is overpricing for call options in case of Tesla, because what we can see is that the call pricing skew is 38.3%, which means that at the expected level, call prices are 38.3% more expensive than put options at the expected move level. So that's how we can tell that the market or the underlying options traders for Tesla are overpricing for call options. This is what is measured by the call pricing skew. You see the skew in here, and you also see it down here at the oscillator level on the bottom of your screen. If you are looking at the delta curve and hover your mouse above these points or dots, you will also get this information based on every single expiration. For example, this tells you right here that call costs 12.7% more at the binary expected move at this expiration, the 6th of February. As this is a number around 60 days, if you want to see each and every pricing skew, vertical skew on every expiration, you can do that by hovering over your mouse over these dots on the delta curve. You can also enable the weekly expiration by going here and say weekly expiration in the future, 5 weekly expiration. Then with the lighter gray, you will see these vertical expiration lines that are showing the weekly expirations in the next couple weeks or months. So now let's talk about what the skew is actually telling you as an option trader. Once again, it's very important to understand that if you are looking at a skew, it does not mean that the market will go up if you see a call pricing skew. It just means that the participants in the options market are willing to pay more for call options than put options. And this usually happens for a lot of stocks that most of the time they have call skew. If you look at the Tesla, and we will talk about this later, this oscillator shows you the pricing skew historically. It tells you that there was always a call pricing skew in Tesla in the last couple of months. Because if we are looking at this histogram, this is showing you green levels, and these green levels mean that there was always a call pricing skew in Tesla. There are certain stocks in the stock market that are having always call pricing skew. That's why I'm telling you that if you are looking at a call pricing skew, it does not mean bullishness. It means that there is a call pricing skew sentiment, so the market is overpraying. If you are looking at the extremes of pricing skew, that's where you might get some kind of directional probability, but it will never tell you the direction exactly. It just tells you how the markets are paying for options. If you see a call pricing skew, the speculation is on the upside. If you are a put pricing skew, the more focus is on fear and protection, because people tend to overpay for put options, for example in SPX, because of protection and because of fear. It's also important to understand how professional options traders are using skew to determine or select their strategy. For example, if I see a call pricing skew on the upside, I might buy a butterfly, because butterflies tend to be cheaper than when the call pricing skew is lower. So going with a butterfly on the upside and the call pricing skew is high would be a better choice than buying overpriced calendars or diagonals. So the pricing skew itself does not only show you the sentiment of the underlying options market, it also helps you find and tailor the right option strategy for your trading idea. Like I mentioned before, like a very high call pricing skew is better for call butterflies than for call calendars or diagonals or any time spread combinations. Now that we have talked about the vertical pricing skew, let's move on to the horizontal IV skew, which is another part of the Options Overlay Pro indicator. If vertical skew tells you which direction the market is paying for, then the horizontal IV skew tells you where in time the market is paying for volatility. This is the missing link for anyone trading calendars, diagonals, or any time spread. Let's talk about the term structure of volatility. Under normal market conditions, implied volatility follows a very intuitive pattern, which is options with later expirations typically have higher implied volatility than near-term options. In other words, the short-dated options are cheaper, the long-dated options are more expensive, because more time means more uncertainty, and more uncertainty also means higher implied volatility. This is an upward sloping structure, which is considered normal, and this is called a contango, where the term structure is upward sloping, the backwardation is downward sloping term structure. When we see that the front expiration IV is higher than the back month expiration IV, that's called backwardation. And when we see that the front expiration IV is lower than the back expiration IV, that's called contango. So when we are talking about backwardation, it means that the front month in terms of implied volatility is more expensive than the back month. When we are talking about contango, that's the normal case, is when the front month is cheaper in terms of volatility than the back month. That's called contango. This horizontal IV skew is one of the most important conditions for calendar, diagonal, or time spread combination strategies, because you want to see where volatility is high, because that's where you want to sell the option in a time spread, and you also want to see where volatility is low, that's where you want to buy the option. Because usually when volatility is misaligned across expiration, time spreads tends to gain a structural edge. Without understanding the horizontal skew, calendar trades becomes just coin flips. There are certain parts of the overlay indicator where we show you the horizontal IV skew. For example, if you hover over these dots on the delta curve, you will see, for example, the weekly skew tells you that 2.3% around 16 to 23 days to expiration. This is what we also will cover in the expiry table. So for example, if we go here at this expiration, the 13th of February, which is here, you will see that the 13th of February will have a 51.14% IVX, and the next expiration after that will only have 49.64. That means there's a backward-dated IV skew, the horizontal skew, because this expiration has a higher IV than this expiration. So if it's plotted in purple, that means there is a backward-dated relationship between the two expirations. And if you hover over these dots on the delta curve, you also see a purple dot, which tells you there is an horizontal IV skew backward-dated relationship between these expirations. That's the same purple sign that you will see here in this expiration table or expiry table. If you want to compare the expiry table skew to the TanukiTrade live platform, you go to the Tesla option chain, you select the expiration, you do the math with the implied volatility, and then you will see where the backward-dated skew or contango is. They are not showing you the exact numbers of backward-dated skew. This is what we are calculating in here. Here you only see the exact IVX numbers, so you have to do the math and see where the backward-dated or contango is. For example, here in this expiration, there is a 56.1 IVX in the front, and on the back 51.6. So that's obviously a backward-dated IV skew relationship in terms of the term structure. Hovering above these purple dots, you will see the weekly IV skew. If you hover over this, you will also see if there is a monthly IV skew between the monthly expirations. If you are trading long-term time spreads or calendar spreads, then monthly IV skew might be helpful for you as well. Going back to the IVR panel, once again, if you click on settings, you can control if you want to also see the monthly IV skew and the weekly IV skew. It will show you the monthly and the weekly IV skew based on the settings in here. So if you don't want to see any of these, you can just unclick and deselect them, and then it will not bother you with the term structures. If you are not a calendar spread or diagonal spread trader, if you never trade time spreads, then probably the horizontal or time skew structure is not very important for you. Now let's talk about the expiry table down here. This section is all about turning option chain complexity into clarity, because instead of jumping back and forth between charts and option chain, the expiry table gives you a clean structured view of how volatility and pricing behave across expirations. So why did we add the expiry table to the options overlay indicator? It's because many option traders think visually on charts, but when it comes to expiration selection, a table is, often the fastest and clearest way to compare these values. The goal of the expiry table is to compare implied volatility across expiration that I showed you before, identify the time spread opportunities instantly, and also evaluate the pricing skew expiration by expiration. What you can see in this expiry table is the expiry date itself, the days to expiration, the IVX value of that specific monthly or weekly expiration, the vertical pricing skew, as mentioned also in here, and the binary expected move value up or down at that specific expiration. If you click on these settings, you have another options to see in this expiry table, like the standard deviation one or the OTM data curve values. If you enable those values, you will have new columns that will show you the standard deviation one, which is this line, the binary expected move for every single expiration, and also the 16 data curve for every single expiration. So this is a visual representation. This is a numerical way showing it in a table for comparison if you prefer that. If you don't, then you can go back to settings and just deselect all these expected range or price curves, and then it will not bother you with the details. Sometimes it's very useful to see how the options market is pricing the vertical skew. For example, in the front expiration, the market is paying more for the put side, more for protection, but in the longer expiration, they are paying more for the call side for upside speculation in terms of Tesla. So this actually tells you something very important. The market may be cautious or defensive in the short term, but pretty optimistic further out in time. It will never show you the direction. Obviously, as I mentioned before, pricing skew never tells you where the market will go. It just shows you the sentiment easily. So I think this expiry table is a pretty useful addition to the overlay indicator, but if you don't care about it, you can just hide it. If you go back to settings and click on expiry table position and select hide, then you can hide the whole thing and it does not bother you again. If you want to enable again, then you can go to, say, bottom left, where I usually have it. So far we have covered all the options metrics in Options Overlay Indicator. Now move on to the grid system part that we call the Options Trader Grid System. If you click back on settings, you will see the grid, the horizontal lines, the Murray Math enhanced levels, and also the vertical line, which I already showed you previously, where you can enable the monthly expiration, vertical lines, and also the weekly expiration lines. So what we invented as Options Traders Grid System is fundamentally different from the basic grid system built into the TradingView application. The TradingView's default grid is purely visual. It shows evenly spaced horizontal and vertical lines, but it tells you nothing about meaningful price levels, options expirations, volatility adjusted structure, or expected movement. The general grid lines in TradingView can be disabled in here. If you go to Canvas and grid lines, you can say none. If you don't want to see the grid lines of TradingView, you can disable it here and use our grid system that shows you the horizontal Murray Math line and vertical expiration lines. There is a big difference between the grid system and the Options Overlay Options metrics, because as I previously mentioned, for the options metrics, we only cover around 160 plus liquid options symbol in the US equity market. But for the grid system, you can use any symbol in TradingView. So for example, if I switch to AstraZeneca, for example, which we don't cover with options metrics, but still you can see the grid system. So the Options Trader Grid System works without any restriction. It can be used on any ticker, any asset class, even on instruments where options metrics are not implemented, or even instruments that have no options at all. If you want to see the correct lines that we are using in the grid system, right-click on the x-axis and enable Scale Price Chart only. That's very important. You have to enable this to be able to see the grids correctly. Now let's talk about the enhanced Murray Math lines, the horizontal component of the grid system. The Murray Math is based on principles originally observed by William Gann, who studied symmetry and repetition in the markets. Murray later adopted these ideas to make them more accessible and practical for all traders. The core idea is simple behind it. Markets often react, stall, or reverse at specific structured price intervals. At TanukiTrade, we don't treat Murray Math as a prediction tool. It's not a crystal ball. It's not a holy grail. It's just a tool. Instead, we use the Murray Math as a structural framework. If the market trend is aligned, Murray Math levels help you understand how far price is likely to travel. Remember, it does not tell you the future. It just tells you how far price is likely to travel within a given time window, such as like a monthly or weekly expiration. In the Murray Math lines, there is a key concept called the unit step. One unit step is the distance between two adjacent Murray Math lines, for example, between the 4/8 to the 5/8. This is called 1 unit. 4/8 to the 5/8. This is called 1 unit, 1 octave. These unit steps divide the price range into structured segments. 4 unit steps from 4 to 8/8. This is called a quadrant. I wanted to show you this picture from some of our tutorials where we show exactly how these quadrants and units are looking like. Right now what you can see that this is a picture where it shows you that from 0/8 the price usually travels to 4/8, then 4/8 to 8/8, and this is the upper extreme quadrant. When the 8/8 left, the market is going above the 8/8, going to the plus 4/8, and then usually reverses, or it's the same on the downside when the market breaks down from the 0/8 level to the minus 4/8 level. That's the lower extreme quadrant. This is where someone might expect a bounce. So these levels are shown for every single instrument in TradingView. So again, these lines are not predictions, but if you look at the Tesla, it was very nice that it bounced back from the 8/8 on the upside. But again, this never tells you the future. But if the Merrimack lines or levels are in confluence with, for example, a core resistance or a put support, they might be stronger and have a higher probability that something happens at these levels. These levels are not for prediction, these levels are reaction zones. So if underlying reaches 8/8 or 0/8, watch there and see how the market reacts. And if there is a momentum, then follow the momentum and trade that direction. And one of the most powerful aspects of this grid that it's adaptive. As volatility changes in an underlying, the unit steps expand or contract and price structure rescales automatically. So you will not see the exact price units like you see at Tesla. For example, if we go back to Apple, you will see a very different price units. These are more narrow. If you see a more volatile underlying, the unit distances will be higher. If we are looking at Amazon, the unit steps are different from Tesla or Microsoft or Google, because this underlying, this stock has a different personality, different volatility, and different vibration. But if we look back at the 8/8 on the upside, it was a very, very nice level where the market bounced back from. So the question comes, how do you use this grid with the options metrics? And I guess the real power comes when you combine the grid system with the expected move or standard deviation delta curves and the skew, and also the GEX levels, like I mentioned before, the core resistance and the put support. So again, this grid system is not just like a random pivot system. This is based on the underlying volatility, move, and structure. It helps you organize price action and contextualize the volatility of the underlying. I wanted to show you a couple of settings in the Merrimack line. If you go here and you can click fallback only, always show or disable, which means that if there is no options data, no GEX levels for any underlying, then you can say that, okay, fallback only. So Merrimack lines will be only displayed when there is no GEX or there is no GEX lines. I guess this is the default settings. If you want to always see it, click on always show, and it will always show no matter if there is a GEX level or not. So for example, if I enable the GEX profile for Tesla, you will see the GEX levels. For example, I change it to every expiry, then you will see the every expiry of Tesla and in conjunction with the Merrimack levels. So it depends on you if you want to see them both together or you only want to see Merrimack lines where there are, for example, no GEX lines because you are watching an underlying that we are not covering. You can display the labels for the fractals. If yes, then the 8/8 or 4/8, these will be shown, and you can also select other time frame from enhanced lines. I usually use the chart. You can go by 1 second, whichever time frame you are trading, but I usually stick it with the chart default time frame because I want to see the Merrimack lines only on the time frame that I'm watching for the underlying. And here are the other lines I already talked about, the vertical lines for expirations. Going back, I will deselect the GEX profile because we will cover that in a later video. So I think I have covered everything related to Options Overlay Pro. Now let's move on to Options Oscillator Pro. Now I have switched to NVIDIA, and let's see what the Options Oscillator on the bottom of your screen is telling us. So first of all, there are two sections of the Options Oscillator. This part is showing us GEX information. These vertical bars are showing the net gax for every single expiration and other relevant information. But since this video is not about gax profile and how to understand gax, I will not cover this part of the options oscillator in this video, because I would like to create a separate video in the future about gax and gax profiles and how to interpret gax on a chart. So if you are not interested in gax, you can go to settings in here and you can disable these informations, and then it will be gone from this toolbar and from the oscillator as well. And if you realize that if gax is enabled, the whole scaling of this chart changes because of the bars are disappearing or hidden. So if you want to see the implied volatility rank, or IVX, in a better scaled version, then, and if you are not interested in gax, you should, disable these gax profiles and other settings. So right now what you can see on the oscillator are the information that we have already covered. Let's go through all of them. So here you can see the IVR, which is the same as this IV rank. This is telling you the IV rank of the underlying product. It's already in the IVR dashboard as well, and on the oscillator as well. If you don't care about the oscillator IVR, you can always disable this information. For example, you can say that I don't care about the IVR cell. You can disable this IVR cell. You see it here. And if you are not interested in the IVR line, which is here, you can also disable the IVR line as well if you are not interested. But then now let's enable both of them. What else you can see on this toolbar is the IVR, the IVX that is already shown here. So these are both information are the same. The implied volatility change in the last 5 trading days, it's exactly the same number. The call pricing skew or put pricing skew, depending on which part of the option chain is more overpriced. And the other information in here is when the indicator was last refreshed. This telling you 11 hours and around 30 minutes ago it was refreshed, because we are already out of market times. So this toolbar is pretty handy, but if you don't want to see it, you can disable all the toolbar information. Like if you go to IVR settings, display IVR cell, display IVX cell if you don't want to see that, and display IVX 5-day change cell. And you can also disable the CP skew cell, which stands for call or put pricing skew cell. So if you don't want to see any of these cells in this toolbar, you can disable them, but I like to see them, so I enable back. And so these are the information. If you don't want to see, for example, the IVR toolbar because it's redundant, then you can only go to see that. It depends on your personal preference. The other part of the options oscillator, this part, is showing you historical information about the following values: the IVR, the IVX, and the pricing skew. So right now with purple, you see the IVX value of the underlying historically. The blue one shows you the IVR value, and this histogram is showing you the pricing skew. If you see green mountains, quote unquote mountains in here, or oscillator part, that tells you there was a call pricing skew. If you see like a gray one, the pricing skew is irrelevant. If you see red one, the pricing skew is dominated on the put side. Here it's not relevant. Here it's again bullish pricing skew because it's showing you call pricing skew. If we are zooming out from the chart, you will see that the first value started to being recorded back in July 2024. So before 2024, July, you will see nothing. But since then, we started to record the pricing skew, the IVR and IVX. And these IVR and IVX values are exactly the same as you would see on the TanukiTrade platform. But nobody tells you the pricing skew, especially historically. So for example, if you go to SPX, you will always see a negative pricing skew because there is a tendency that the market participants are buying protections on the put side for SPX. So you will probably never see a call pricing skew in SPX. But there are situations where the market is so complacent, for example, at these levels here, that they are not really buying any puts. So that's why there is a very, very low put pricing skew. That also can be kind of a sign. It's not a directional indicator, as I said many times, but if there is a very low level of pricing skew or very high level of a pricing skew, that can tell you something. For example, this was pretty high. The market was really, really pessimistic because you never see a pricing skew high like that before, and the market just turned. So it's not always working. It's not the holy grail. It cannot tell you the future. But for example, last time when we had this Greenland panic, there was a very huge upside put pricing skew here. And if you look at that peak and this peak and this peak, the market just turned back up from that very pessimistic level immediately the other day. So although it's not like a directional indicator, it's not telling you the future, but if you see extreme values around this area, then you should watch that level, that's for sure. And sometimes you see that when these bars are pretty high, they tend to distort the IVR and IVX levels because we cannot show you the IVR and IVX on a different scale like that. So if you want to see it more clearly, just double click this area and then you will see the histogram and also the IVR and IVX values much better. Or if you don't care about the histogram and you don't care about the call or put pricing skew, but you want to see a very clear, nicely scaled IVR and IVX values, then you should go to the settings and disable the call put pricing skew lines. So then the scaling changed back to the normal level based on the IVR and IVX averages or scales or range. So this is how you can see better the IVR and IVX values if you don't care about the pricing skew. But I think the pricing skew can be very good information about how the market is positioned and what's the sentiment around different levels and different ranges of the price of the underlying. Now let's switch to Tesla, and I will show you that in Tesla, the histogram historically shows you most of the time a core pricing skew. Meme stocks or hype stocks tend to have core pricing skew all the time, but here nobody was bullish. For example, I wouldn't say nobody was bullish, but the core pricing skew was pretty low. You don't see or rarely see a core pricing skew that low in Tesla. What happened after that? The market went up. It's not a prediction. It will not tell you the future, but this historical histogram analytics can tell you something about the current market level and the positioning and the sentiment. Now let's switch to Apple because I wanted to show you something interesting on this histogram, the put pricing skew histogram, that Apple tends to have core pricing skew and put pricing skew as well. Previously, you see that Tesla almost always have core pricing skew, but there are certain stocks that have put pricing skew and core pricing skew as well. So it really depends on the stock personality. That's why it's important or very useful to analyze and study the histogram in the last couple of months or years that we have data for. And for example, here, when everybody was pretty bearish about Apple, the price level was pretty bearish and also the put pricing skew. You never see a put pricing skew high like that in here. This was a huge peak. And then the market turned down, the put pricing skew increased, and the market went up. And right now what you can see on Apple that the put and core pricing skew is just neutral. It means that the market participants are not hyped on the upside and not hyped on the downside. It's neutral. But again, if you are familiar with the histogram of put pricing skew for a stock, and for example, you see a very high level of core pricing skew or put pricing skew confluencing with, for example, a Merrimack level or a GEX level, like a core resistance or put support, then you can have an idea. It's just a reaction zone, but then you know that you have to watch those levels because something might happen. Again, not a directional indicator and not telling you the future, but there are certain situations in the market. If you are watching these levels and you are familiar with those, then you can have a better opinion of what is going to probably happen next. So it's a good exercise and a good idea to study and analyze these histograms for your favorite stocks or ETFs. I wanted to show you another stock that is pretty hyped nowadays called Micron. If you look at the last half years of performance, this is just crazy because the market went from around the 100 level to the 400 level. If you go back and study the pricing skew of Micron, you will see that most of the time it was a core pricing skew. But here, there was something that is very unusual because the market was pricing the put more heavier than the call, and there was a neutral area, and since then the market never turned back. So that's another important area where you should watch and see that how the market will change, because it's rare to see a put pricing skew in Micron. That's why I tell you that it's important to understand your product, your underlyings, and get familiar with the parameters and values and ranges in terms of the historical pricing skew, the IVR, IVX, and all the rest that is relevant to the current stock. So with all that said, I think I have covered every important and useful information regarding the Options Oscillator Pro indicator. So I hope that you can see by now that using the Options Oscillator Pro and Options Overlay Pro can really help your swing trading if you are an options trader and if you are using TradingView. I know that we have covered a lot in this video and it can be too much at first, but please be patient, go step by step and get familiar with the tools, and you will see how it can help you in your swing trading. And I'm sure that you will see with a little practice that these tools can be really helpful in your swing trading and options trading. So if you have any questions about this video, please feel free to contact us. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.